Headline inflation numbers were just published. The 10-year Treasury skyrocketed. What does this all mean for the real estate market in the Tampa Bay area? Stay tuned and you'll find out. So CPI came in at a hot 8.2%, exceeding the 8.1% that was expected. As a result, the 10-year Treasury increased to over 4% by week's end. This is the highest interest rate that we have had in over 20 years. So a fixed 30-year mortgage rate is sitting between 7 to about 7.5%. That could vary, and it can vary on Monday if the 10-year Treasury decides to decrease a bit, and it can vary just based on other variables. But for the most part, it would be an indication that rates are continuing to rise. Now, if you're a seller, one of the things that you need to consider is that a buyer's purchasing power decreases by 10% for every 1% interest rate increase. We understand rates were at 3% at the beginning of this year, and they're now sitting at over 7%. That's over a 40% reduction in buying power. That does not mean the same as housing prices being reduced by 40%. That just means you have fewer buyers at that price level because now those buyers are being priced out. Now they're being forced into lower price points. So doesn't mean that it's over, but you do have to adjust your expectations accordingly to ensure that your pricing is in line what the masses essentially for your price point can handle. Now, if you're a buyer, what it means is it's time to really get those concessions back into place, and we still have people buying homes. Our inventory has ranged from about 10,800 units in the Tri-County area to about 11,100 units in 3 months, which is absolutely flat. So we're not seeing an inventory really increasing to the point where it's out of control. But if you're a buyer and you're smart, so the objective is to work with an agent with our kind of experience who can help you navigate on getting the seller to pay for your rate to actually be lower than par. So par right now we know is between 7 to about 7.5% as of today. But if we buy down your interest rate and let's say we get 3 points from the seller, that could be a significant cost savings of hundreds of dollars per month. Now, if you reduce the purchase price of the home where you can have an impact of, let's say, a $10,000 price reduction is worth $50,000 versus $10,000 in a rate buy down will save you about $250 per month. That is a huge difference between the two. So it's oftentimes better to request a concession towards a rate buy down versus a price reduction. So again, real estate prices are remaining pretty steady, slight reductions, and one good way to really analyze what's going on in the market is to see what builders are doing. And builders are buying down interest rates. So again, on the pre-owned market, especially if there's a specific area that you want to live in, why don't we go ahead and request the seller to buy down your interest rate? It's an option. Now, I understand that rates will probably still be at the highest level that they've been in 20 years. You get the rate buy down, your payment's a little bit more comfortable, but it still beats the interest rate on rent. That's 100% because you're not getting any equity out of it. For every payment that you make on your own personal mortgage, your balance is actually decreasing. So that is called equity. You're gaining equity. Any short-term price fluctuations will in fact be short-term. We are not in a credit crisis. We are in a situation where inflation has to be under control. Now the expectation, I don't know, let's look at the average time for recessions. Could it be 6 months? Could it be a year? Could it be 18 months? But prices historically will always increase. So if you have any questions, feel free to reach out to us. We are very, very capable of navigating through this market, whether you're a buyer or seller, and we'll be happy to answer any questions.